Good afternoon, everyone, and thanks so much for joining us for today's webinar. My name is Mary Ann Hensley. I'm the Vice President of Media Operations here at FreightWaves, and we are happy to have you join us today as we discuss how trucking freight futures can be used to manage risk. I'm happy to be joined by Tom Mallon, Vice President of Freight Futures Markets for FreightWaves, as well as Kyle Lintner, Principal and Director of Markets at K-Ratio. And they'll be discussing the opportunities that futures present, how they work, how they can reduce your exposure to spot market volatility. We'll also have a live Q&A with them following the presentation, so be sure to get your questions ready, and you can submit those anytime you like through the Q&A button in your control panel. Also, if you have any tech issues during the webinar, feel free to reach out to our team through the chat button in your control panel, and we'll take care of that as those come in. At this point, I'd like to go ahead and turn it over to Tom. Take it away.
Thank you very much, Mary Ann. Good afternoon, everybody. My name is Tom Mallon. As Mary Ann said, I'm the Vice President of Freight Futures Market at FreightWaves. Just a little overview of FreightWaves and who we are. FreightWaves is a media and technology company, and we were built to build out a world-class community in freight that uses both data and technology to help the markets understand what's going on, react to things that are driving the market, project changes, and then ultimately de-risk their exposure to volatility in freight rates. That is the purpose of trucking freight futures. Why we exist? To empower the freight community that has traditionally struggled to deal with risks and volatility in the freight markets. And we do this through a number of different ways. First, we deliver data and analytics through our SaaS-based platform called Sonar. We do it through our commentary and our market coverage through FreightWaves.com. And then we provide tools and risk management capabilities through trucking freight futures. Just a quick overview of where we're at with trucking freight futures. Trucking freight futures launched back on March 29th. They launched on the Nodal exchange, which is our exchange partner. The first ever trucking freight futures contract traded on the launch date. The April Van National contract traded at $1.34 per mile. Since then, we've had two large commercial hedges. Back at the end of July, we had a 50,000 mile hedge, which equates to 50 trucking freight futures contracts. 25 contracts traded in each of the October and November 2019 contracts for the Los Angeles to Dallas lane. And then back on August 6th, we had another 15,000 mile or 15 contract hedge. That transaction took place in the Seattle to the Los Angeles to Seattle lane, with 5,000 contracts, 5,000 miles trading in each of the October, November, and December contracts. The result of those transactions are 65,000 miles of trucking freight futures open interest on both of those lanes. So 50,000 on the LA to Dallas lane, and another 15,000 on the LA to Seattle lane. Regarding participation on the platform and in the market, we currently have 6 approved participants on the Nodal trading platform. We also have an approved liquidity provider on the platform. And we have a large and growing pipeline of companies that are in one stage of the approval process or another with the Nodal exchange. A little bit about the size and opportunity of the market. The market size for trucking is huge. It's roughly a $730 billion market. You put that into perspective, it's about 30% larger than the oil and refined products market, about 40% larger than the agricultural market, and about 45% larger or 50% larger than the electric power markets. So it's a massive, massive market. And what's interesting about trucking is that in the other markets I just mentioned, there are already in existence a very liquid and vibrant futures markets. The actual size of the market in reality can be much bigger. Futures by nature operate with a multiplier effect, meaning a single futures contract is going to trade in multiple times. There'll be generally a 8 to 10 time turnover of futures. We were conservative on our estimates in saying that a single futures contract will turn over or trade 4 times, meaning that the theoretical size of this market is upwards to $3 trillion. So it's a massive, massive market. Recent futures contract launches in the commodities space. I talked about oil. The WTI futures contract was launched back in 1983 on the NYMEX exchange. The underlying size of that market is about $420 billion. Natural gas futures were introduced back in 1992, again on the NYMEX. This underlying size of that market is about 140 billion. And then electricity futures have been introduced on various exchanges, most recently on our exchange partner, the Nodal exchange. The underlying size of that market is about 400 billion. Going back to the slide before, we're talking about an underlying market in trucking of about 730 billion. So again, underscores the point that it's a massive, massive market. And up until March, there was no way for the industry to de-risk itself from volatility in trucking freight rates. The freight industry itself, transportation costs are a massive component of US GDP, about 8%. If you look at freight, it is a larger component of the cost of goods sold than energy in many sectors of the economy. This is a really interesting point here, is that there continues to be reported by S&P 500 companies that freight and transportation costs represent the most serious risk to earnings. And then just recently, we've seen a number of trucking companies, go out of business, exit the industry. We're at the highest point in terms of companies exiting the industry since 2016. Freight rates are massively volatile. The slide here shows the volatility in underlying freight rates. This is the DAT Van index, which is the basis that is used for final settlement of the futures contract. If you look back since middle of 2014 through the middle of this year, you can see the massive swings up and the massive swings down in spot freight rates. Today we are in an environment where freight rates are relatively low compared to this time last year. So from a shipper's perspective, this would be a really good time to look at futures, consider using them as a mechanism to lock in these depressed rates going forward into the future. What causes volatility? There are a number of factors that cause volatility. One of the biggest factors today is Donald Trump and his Twitter account can cause massive, massive swings in volatility across many markets, including trucking freight rates. What's going on with trade policy is a huge driver of the markets today. We recently saw in the last 2 days that China is backing away in a sign of good faith from implementing a large portion of the tariffs that they were slapping on goods coming to the US. The US in turn has backed away and deferred the implementation of tariffs from October 1st out to October 15th. That will impact potentially freight rates. And we've already seen this happen in recent situations where, because of the trade war and tariffs, you've seen a shift from freight moving to the West Coast, now coming through to the East Coast. And accordingly, we've seen an increase in trucking freight rates because of freight coming into the port of New York and New Jersey. We've seen freight rates rise along the Philadelphia to Chicago lane as an example. Other key drivers are weather. Seasonality plays a huge component in volatility in freight rates. what Amazon does plays a huge component in volatility, and then just general economic health and stability of the overall macro economy. So what do you need to build a vibrant and liquid futures market? Well, we talked about the fact that trucking is a massive market, $740 billion market. The freight rates associated with the spot market are highly volatile, as we've seen in the DAT index. In order to create a futures market, you also need a reliable mechanism by which to settle futures contracts. So we have partnered with DAT Solutions, and they are providing a price on a daily basis based on an index that was created off of the methodology produced in concert with the Nodal exchange, ourselves and DAT, to create prices which will then be used to cash settle the spot market contracts. So these are cash settled contracts. And then finally, you need a reliable exchange partner. And so we partnered with the Nodal exchange. The Nodal exchange is a regulated exchange here in the United States. It's governed by the Commodity Futures Trading Commission, which oversees all futures trading here in the United States. The Nodal exchange itself is owned by one of the largest exchanges in the world, the Eurex exchange. And then we tie it all together, FreightWaves, through our data, through our analytics, through our news and our insights, and just the overall tribal knowledge that we have in the marketplace. So who is naturally exposed to freight rate volatility? Well, shippers. We estimate there are about 20,000 shippers that spend more than $10 million a year on trucking freight. You've got the trucking companies or the carriers. We estimate over 4,500 companies with at least $20 million in revenue that are also exposed to volatility in spot rates. And then the freight brokers or the intermediaries, about 1,600 of them with at least $10 million in revenue per year have an exposure to volatility in freight rates. And based on all of this, we estimate that the futures market contract size potential is about 40 billion miles. And we come to, which equates to 40 million futures contracts based on a standardized futures contract being 1,000 miles. And I'll talk about that in a minute. But we come to that number based on the estimate of $730 billion overall size of a market. We take out from there the contracted market and just include spot rates only. We also take out other modes of transportation, such as refrigerated transportation, flatbed transportation, intermodal. And from that, we came up with an estimate of 40 billion miles that are subject to spot rate volatility. The trucking freight futures contracts themselves. We worked with DAT and the Nodal exchange to come up with a network of lanes which touch 6 transportation hubs. So the network themselves consists of, on the West Coast, the LA to Seattle lane and the LA to Dallas lane. We average those 2 lanes and we come up with a West Coast average. In the South, we've got the LA to Dallas, Dallas back to LA, average those 2 lanes, and we come up with the Southern average. And then in the East, we have a triangle, Chicago to Atlanta, Atlanta to Philadelphia, Philadelphia back to Chicago. Average those 3 lanes, and we come up with an Eastern average. We take the average of the 3 regionals, and we have a national average. So from this network of freight lanes, we've created 11 futures contracts, which are now listed for trading on the Nodal exchange. The rationale for selecting these lanes were that we chose highly liquid lanes. And by what I mean by that is there are a lot of dry van freight moving on each of the individual lanes. the lanes themselves are not dominated by any one single carrier or one single shipper. So there are multiple carriers, multiple shippers moving freight along each of the individual lanes. The lanes themselves are highly liquid. And what that means is about 24% of all freight in the US is actually moving along these 7 lanes, which correlates to about 84% of the freight nationally. So these 7 lanes are highly liquid. They correlate, not only directly to the individual lanes, but they correlate on a national and a regional basis, giving the market an opportunity to use these lanes and manage their exposure regardless of where physical freight is actually moving throughout the United States. I talked about the 11 contracts. And the cities themselves, the Los Angeles or Seattle or Dallas or Atlanta, they are defined themselves by 3-digit zip codes. And that, the number of 3-digit zip codes actually form the bounds of what we would call the city themselves. The contract types are monthly. They are cash settled contract, meaning that there is no physical truck involved or no physical goods that are involved in buying or selling a futures contract. They are simply financial contracts that are used to offset an operational risk or exposure to volatility in freight rates. The indices themselves, they're based off of the DAT trucking spot rates. So it excludes all contracted business. It excludes accessorial charges. It excludes any fuel. And so these are rates that are collected by DAT. They are rates that represent freight that are actually moving on each of these 7 lanes. They are electronically reported to DAT. So these are real rates for real freight movements along the lanes. The futures contracts themselves, they're settled daily. So on every day, there is a settlement price that is created by the Nodal exchange. That daily settlement price is based off of market activity, whether it be a bid, which is an intention to buy a futures contract, an offer, which is more actual input from DAT positions. And by that, I mean anything that a futures contract that is open and can go to final settlement. I referenced before that today we have 65,000 miles or 65 contracts of open interest. Those are open positions that get marked to market every day, meaning that based on a settlement price at the end of the day or an interim price that is taken by Nodal exchange, those positions are marked to market, meaning that if you own a futures contract, you could have cash deposited into your account if the market moved in your favor. If you owned a contract and it moved against you, i.e. it went down in value, you may be required to put money into your account. That is called margin. The type of contract, it's based off of dry van line haul rate only. So as I mentioned, it excludes diesel fuel. It's dry van only, meaning that these are not refrigerated prices, nor are they flatbed. These are dry van line haul rate contracts only. The size is 1,000 miles. So that is the standard for every futures contract, 1,000 miles. And it's representative of the long haul trucking. The contracts themselves are quoted in dollars and cents per mile, meaning that if you have a contract of 1,000 miles and the average rate, for example, is $1.50, the notional size of the futures contract is $1,500 for that futures contract. The contract series, meaning the time series going forward, contracts go out they go out 16 months. So I could buy or sell a futures contract today for a month, 16 months forward. And so that would be out to November 2020. The last trading day of the futures is the last business day of the calendar month. The final settlement price and where cash will actually change hands will take place up to 8 business days later. But the last trading day for a contract month is the last business day of that month. So we are in the September month today. So the last business day of September would be the final trading day for this month. And just to emphasize the point, there is no truck involved in trading a futures contract. So they are financially settled. A truck will never show up. How do you trade a trucking freight futures contract? Trucking freight futures contracts are listed on Nodal exchange. So what you need to do in order to trade a futures contract is to execute the Nodal trading participant agreement. It's a standardized know your customer form that the Nodal exchange provides. It's available through FreightWaves.com or going to the Nodal exchange's website. Second thing you need to do is establish a banking relationship with one of 12 approved banks or clearing members on the Nodal exchange. And I've listed the approved banks that are approved to clear transactions on the Nodal exchange on this slide. The third part is you get your approval. So, you submit the Nodal trade participant agreement, you establish your relationship with a clearing member, and you get approved by the Nodal exchange. And then after approval by the Nodal exchange, your clearing member will then set you up on the Nodal trading platform in order to trade the futures contracts. And here's an example of the Nodal trading screen. The screen that I actually am showing here is the trading screen from when the actual hedge on the LA to Dallas lane was put on the exchange. So if you look at the screen, you can see that the 2 trades that happened in the October and November months for 25 contracts or 25,000 trucking freight futures miles equivalents. And this is the screenshot from the LA to Seattle hedge. Again, a 15,000 mile hedge, which took place last month. And with that, I'm going to turn the presentation over to Kyle Lintner from K-Ratio.
Thank you, Tom. Like Tom said, my name is Kyle Lintner. I'm with a firm called K-Ratio. For legal purposes, just to get it out of the way, we are a CFTC registered CTA. That simply means that we are legally allowed to provide risk advisory services and opinion based on futures markets. Personally, I have close to 20 years experience trading futures, so it's become my entire life, and I am very excited to show you guys what futures can do in an industry like freight. So as you see on the slide in front of you, just to put us all on the same page, we can see one of the contracts available for trade, and this one in particular is the DAT National Average. This is a 1-year look back from June to June, so June 18 to June 19. If we think back to last year at this time, if you're a shipper, things were probably pretty tough. If we move it forward to where we are now, things are much easier. And the goal of futures are to keep times like right now for your business moving forward. And what I mean by that is, if we see on the next slide, we can take things like a futures market and we can keep the rate that we're paying currently into the future. So if we take a look at that yellow line, that's a rough estimation of what we've seen from 17, 18, and 19 as far as a rate per mile is concerned. We also see 2 different companies represented by the red truck and the blue truck. And as both of these companies are riding the ups and downs in freight rates, now we have a vehicle in front of us in the form of freight futures where we can lock in that rate. So the company in blue uses freight futures to execute positions inside of the market, and they're not subject to the next swing higher up in rates. Obviously, things are much easier now for you as a shipper, but we all agree that this is a very cyclical market, meaning that low rates now will not live forever. The next cycle comes, it will move rates higher. So the company in red that's forced to pay more to get their stuff out the door doesn't have the same functionality as this company we see in blue that's able to maintain stable and low rates moving forward by using futures. And what I mean by that is seen on the next slide here. Whatever price you pay in the futures account or in your futures position is effectively the price that you will pay for your hedge. And what I mean by that is, as the rates fluctuate and move forward, you will always have a net effective rate that's baked into your futures account. So if we look at this chart, on the y-axis we have prices, and on the right, on the x-axis, we have time. If we lock in something at say $1.75, rates move higher, you will pay more in the real world, but that increase in spend is offset by gains in your futures account. Conversely, if we see rates move lower, when you go to move your product out the door, you will pay less to do it, but your trading account will have offsetting losses. At the end of the day, no matter what you do, whether rates move higher or lower, you will effectively spend what you paid for your futures hedges. Another way to look at this is seen on our next slide. Same thought process, just shown visually different. If we are a shipper, we're taking long positions inside of the market. So as line haul rates move up, our real world bank account goes down, but our futures account goes higher. The two offset, again, we're back to the same price. On the other side of the page, if rates go down, we're going to spend less, meaning our bank account increases or maintains a higher value, while our futures account decreases in a mutually offsetting amount. Again, no matter what you do, no matter what rates do, the price you pay in the futures market is the price that you're going to pay to get your stuff out the door. If we go to the next slide, we can see some of this from an example perspective. So what I selected here was the East region. Again, this is one of our averages as far as what's available for trade. Contained within this, you can see over the past year and change, are extreme peaks and valleys of volatility. These swings are above 30%, both to the upside and then consequently to the downside. Obviously, there is some seasonality baked into this, but what isn't baked into these prices are the inevitable changes, whether they're tariffs, tweets, hurricanes, unexpected labor shortages, changes in truck capacity. All the things that we can't forecast are what manifest themselves in these peaks and in these valleys. So what we were able to do for a specific shipper as far as a scenario for them to use hedges is what we'll get to on this next slide. We took that East region and we took their portfolio of business and we analyzed what they had and what was addressable as far as a hedge inside of the futures market. What you see in blue is the price that this company was paying, and what you see in orange is the price that this company could have received had they used the East region as a futures hedge. There were similar movements, but where you see the two separate is what they weren't able to capture because they weren't hedging inside of the market. So as we move chronologically from left to right through time, we see an advantage for that shipper to lower their spend by using the hedges. Now, these were all easy. This is the low-hanging fruit. This is the trips that are over 1,000 miles that match up easily to what we have as far as products are concerned inside of the exchange. What we thought was pretty interesting was some of the creative stuff we found. And if we move to the next slide, we'll see this. This particular shipper had a lot of shorter hauls, things that we wouldn't be able to necessarily correlate one-to-one from a futures hedge perspective. All of those different colors contained within that white triangle are the different lanes that we selected. Again, these were all shorter hauls, the vast majority of them under 500 miles. So individually, they meant nothing, and individually, they weren't able to be addressed inside of the market, but collectively packaged together showed us a different story. Now, most likely, this is just a scenario where we're capturing capacity, because if we think about this from terms of purchasing a truck, whether that truck is going to go 400 miles for us or 2,000 miles for us, we're taking some available capacity outside of the market. So if we think of things in a higher, more macro level environment, and we take some of these lanes and we package them together, put them inside of something like the East region, outside of it visually looking nice in this white triangle with lots of colors, the next slide shows the prices that we're able to capture inside of it. So the blue, again, is the price that this company was paying to move those shipments inside of that East region. The orange is the price of the futures market. And if we take it linearly from left to right as far as a timeline perspective, we can see that had futures hedges been incorporated, we're able to pull that blue line down to where we get to the far right side of the screen, where their price now effectively matches the futures price. If we look on the left side of it and we look what they were paying, it's north of $4. If we look at where it's at the right side of the screen, it's under $2. Obviously, it's not like we created some new idea and we were able to lower their net spend from an actual truck standpoint, but it was simply taking their book of business and their portfolio and applying it inside of the futures market and taking that rate and pulling it down to what is offered to everyone through these products. So this is something that, again, like Tom mentioned earlier, there is not going to be a truck that shows up at your door. So we're not talking about physically getting your goods out the door. But if we deal with only the financial component of it, none of that matters, because like I said earlier, This is all a mutually offsetting gain. Whatever price you pay in the futures market is what you're going to pay to move your goods out the door. So if we can identify strategies like this that marry your portfolio to what's available for trade inside of the marketplace, we're going to get that end result that we see on the right side of the screen. Your net effective spend will be lowered, will be fixed, and will be void of any future volatility and variability as far as price is concerned. To put hard numbers on this, the next slide will show us exactly what we dealt with. You can take this level of ship from your company. Obviously, you may be shipping more or less than 17,000 miles, 17 million miles, but this is what we were able to find inside of that East region in particular for this company. This was over a 4-month period, so 17 million miles over 4 months. You see the breakdown as far as contract size and contracts required. What's really important there is that bottom line. This was again, 4-month time period that netted a $5.1 million decrease in spend. Take that over the full year, we're beyond $15 million. If your spend is, or your actual transportation is more than 17 million miles, you can extrapolate from there. The point here is that these are significant savings that are very easy to do from our perspective. It's just taking the risk inside of your 4 walls and placing it inside of the marketplace for it to be dealt with for other people. The reasons to do all this stuff, we've listed them here on the next slide for you. They're somewhat obvious. We're talking about predictable expenses. We're able to smooth out cash flows when we know what our spend is. We reduce the risk by fixing those cash flows and fixing that spend. Again, whatever price you pay in the futures market, and like Tom said, up to 16 months out, you've locked that in and you know you're getting it. If you're a publicly traded company, this is going to improve your shareholder confidence. This is also something that becomes a competitive advantage. Instead of passing along your higher cost of goods sold to your customer or potentially eating profits because your transportation spend is higher, you can now offer a lower price to your customer, or you can match the price that your competitors are giving, but you're spending less to get your goods out the door. So either way you win. It's a wonderful decision to have to make. Again, it's lower expenses, removal of volatility in those expenses, and fixing them to your bottom line. With that, I'd like to open it up to all of you for any questions.
Awesome. Thanks so much to Kyle and Tom. As Kyle mentioned, we would like to go ahead and open it up to audience Q&A. So if you've not already, go ahead and click that Q&A button in your control bar and start sending those questions in, and we'll get to as many of those as we have time for. So first question, what does the process look like when participants are getting set up to trade, and how long does it take?
Yeah, I'll take that. This is Tom. So the process is pretty straightforward. You know, you need to do 2 things. You need to first execute the Nodal trading participant agreement. There's no cost to do so. And what that is, it is a know your customer agreement, whereby the Nodal exchange does their due diligence on any entity looking to join the exchange to trade trucking freight futures. Because there are financial requirements that need to be met in order to be a member of the Nodal exchange. The Nodal exchange, go through that that process. They also go through a background process to make sure that there's creditworthiness and that there is integrity behind the applicant. The second thing is you need to establish a relationship with one of 12 clearing banks that are approved by Nodal to handle customer money at the exchange or on behalf of the exchange. If you have a relationship with any one of those 12 banks, that's very good because the process of getting a clearing account set up would be much shorter. Also, if you've ever traded futures contracts and your clearing member is already an approved clearing member on the exchange, there is no process. On a worst case scenario, the process can take anywhere from 4 to 6 weeks if you've never traded futures contracts before. Also, if you've never traded futures contracts, you likely are going to have to get senior most authorization from top management to designate a financial chief or other designee the authority to manage and trade futures on the exchange. So that's the process.
All right. Thanks, Tom. And next question, can participants buy and then sell a contract at any time, or do they have to wait until it expires?
So actually, once you buy or sell a futures contract, you can buy or sell that futures contract at any time before it expires, provided that you find or provided that there is a counterparty in the market that's willing to buy or sell that futures contract. Or you can hold the contract to final expiration, do nothing, and what will happen is there'll be a cash settlement. And if your position rose in value, you would receive a payment into your clearing account. If it fell in value, you may be required by your clearing member to put up additional capital in order to maintain the minimum capital requirements from that clearing member.
Okay, great. And next question, are there plans to offer more lanes in the future?
It depends on, on market demand. We came up with this portfolio of lanes based on analysis of freight movements in the U.S. And based on dry van. So if there's a need to add additional lanes, we may. But, when we started the process, we had upwards to 18 lanes. And then as we moved through the analysis, we found that taking those 18 lanes down to the 7 lanes, the correlations didn't change in any sort of material way. So the 7 lanes were as good from a correlation standpoint as the 18 lanes. We are, however, looking at, other types of contracts. For instance, we will look at the prospects of possibly offering refrigerated or flatbed. We've also been asked about options on futures as well. So that's something that we will look at. And we've also been asked about the potential for doing things like shorter dated futures contracts, so like weekly contracts, and then rest of month contracts, as well as providing a mechanism to do what they call a strip, meaning you execute more than one futures contract at a single price. So those are some of the enhancements we may consider going forward. Our focus right now is on the 11 contracts that we have on the screen, building the liquidity, building the trading participant community on the Nodal platform. Those are our priorities today.
Okay, great.
Yeah, one thing I'd like to add to that is that it's important for everyone to not just look at the 7 lanes and the 4 apertures that are offered here and be scared, because your shipments and your lanes might not look identical to them. But if you're running something like Madison to Tallahassee, that's going to pair up with Chicago to Atlanta, because the factors that influence the truck in those 2 cities are the same factors that influence the price of a truck in those other areas. If you talk about something like Florida in particular, Atlanta is the benchmark for the rates inside of Florida. So seasonalities between produce or in and out of things like hurricane season, like we just saw with the move-in rates when Dorian came through. Just because your lanes aren't specific to what's offered doesn't mean they cannot be captured inside of the marketplace.
Yeah, great point, Kyle. Thank you. Next question, are there certain types or sizes of companies who may benefit more from trucking freight futures than others?
I'm sorry, could you repeat that question, Marianne?
Yeah, are there certain types or sizes of companies that may benefit more from trucking freight futures than others?
No, I mean, essentially anybody who's subject to volatility in freight rates can benefit from trucking freight futures. There are capital requirements, however, to join the Nodal exchange that must be met. And right now, the minimal capital requirement, if you are looking to hedge on the Nodal exchange, is a net worth of $5 million with a minimum account balance at a futures NFCM or clearing member of $200,000. So there is a financial standard that needs to be met in order to join the Nodal exchange. But futures themselves, anybody who's exposed can use futures to manage their rates.
Okay, perfect. And here to just kind of wrap up, if we could, what are some of the key reasons, really specific to shippers, um, for why they may want to consider signing up for freight futures?
Yeah, I mean, I'll go first, Kyle, and then you can jump in. I mean, the big reason is, the protection that futures offer shippers in the event of a rising rate scenario. And so, I mean, FreightWaves, I mean, if you look at FreightWaves 2 months ago, we were talking about, the freight apocalypse and the freight recession. Now we're talking about recovery. And with recovery, that will mean a gradual rise in freight rates. And so, it's futures are used to manage volatility and exposure. And if a shipper is concerned about an environment where it may be subject to higher freight costs, transportation costs, using futures to lock in a more favorable rate is the key reason.
Yeah, I agree. That's the name of the game. All we want to do with futures is remove volatility and variability. And for freight reasons, that's transportation spend. So if you're a shipper, this is about knowing what you're going to spend and locking that in for up to 16 months into the future. Regardless of what your opinion is, regardless of where you think rates are going, you are not a crystal ball. You do not know where they're headed. None of us do. If any one of us knew what the price of something would be 9 months from now, we would not be in this webinar. We would not be living in this country. We would be on a remote island of our own. So a hurricane may hit. An earthquake might separate California from the United States. All of these anomalous and exogenous events that we cannot control are what dictates rates. So this just presents an opportunity to insulate your price from any increase, from insulate any sort of a risk to your bottom line as far as transportation spend is concerned. If we're talking about cost of goods sold anywhere between 5 to 14%, that's a significant chunk of your company's budget dedicated to getting your widgets out the door. So if we know what that widget transportation is going to be and we can lock that in out to 16 months, it becomes somewhat of a no-brainer.
Yeah, absolutely. Well, thank you both so much for taking the time to share your insights. Thank you to those of you who've been on the line with us today. We hope you found the presentation to be informative and helpful. If you do have any additional questions or would like to request more information, you can visit freightwaves.com and click on the Freight Futures icon at the top menu bar to find some more information and details there. We appreciate you taking the time to join us this afternoon and hope you'll join us again for another webinar soon. Have a great afternoon.